Charles Schwab Chief Investment Strategist, Ann Sonders. Ann, good to see you. So how do you read this market? We're just below all-time highs on the S&P. Tariff threats loom. The investor class did get the tax cuts they were hoping for to offset the rough stuff. How does it look?
So I think, the setup is what you need to consider, given the inability for any of us to gauge in advance what announcements might be related to tariffs and deadlines. If you think back to that fateful first week in April, the setup going into April 2nd was one of a bit of complacency, especially with regard to tariffs. So the setup was one that we're almost inevitably going to see more downside to the extent you got negative news, which is clearly what we got on April 2nd. But then fast forward to only a week later on April 9th, the setup was one of way oversold market, breadth had washed out, sentiment had washed out. So even though really what we got on April 9th was just incrementally better news via the 90-day delay, it was enough to send the market higher. Retail traders have been a big part of this move over the last 3 months. You can see it in areas of outperformance like non-profitable tech and retail favorites and meme stocks and heavily shorted stocks. But I think the setup right now is maybe not to the opposite extreme of what we saw on April 9th, but a decent amount of complacency. And I think that was one of the factors leading to not just the weakness we saw in the market yesterday, but where the weakness resided, which were the same cohorts that got crushed in the first week in April.
Okay. Well, right now on the tariff front, you point out there are no signs that countries targeted with tariffs are adjusting their prices down, but there also aren't clear signs that higher prices on individual products are yet resulting in inflation at the macro level. So will second quarter earnings, you think, give investors a clear signal on what all this means, or do we have to wait for whatever happens after August 1st or whenever these full tariffs actually end up coming into effect?
Yeah, well, I guess that's one of the rubs, is we assumed, given that earnings season starts in earnest next week, that we would have more clarity on the July 9th deadline. That got pushed to August 1st. So there may still be some muddiness in the comments we get from companies, but analysts are definitely going to press companies on what their strategy is with regard to passing costs on. I think they're going to be pressed for questions on their pricing strategy, on the protection of profit margins. The good news is that the better than initially expected earnings for the first quarter weren't extrapolated at all into the second, third, and fourth quarter. So analysts kept estimates fairly low, which means the bar is set low. So I think the reports could be actually fairly positive for second quarter. That's now in the rearview mirror. I think it's what companies say specifically with regard to profit margins, John, because the point is that we wouldn't have expected to see the targeted countries adjust their export prices to U.S. importers. That's not been done in the past. We had no expectation that that would be done. Now we try to put some meat on the bone as to how much do you try to pass on, how much gets eaten out of profit margins.
Yeah, along those lines, I mean, both Bank of America and Goldman Sachs raising price targets for the S&P 500 in the last 24 hours. I mean, is this a market you invest into, or do you wait for a pullback?
I think that the pain trade, as it's called, is probably still a bit higher from a positioning standpoint. You know, the retail trader cohort, their buy the dip mentality has been kind of dead right since the post-COVID bear market era. And in this most recent 3-month rally, it forced institutions to change positioning a bit, cover shorts. But now I would suggest they're no more risk on position than maybe neutral. So in terms of just positioning, I think the pain trade is probably still higher, but there is general complacency, and that suggests some vulnerability, maybe more days like yesterday versus a kind of, major drawdown like we saw in that first week in April.
What is the takeaway from the fact that the S&P 500 equal weight index is still 2% below its record highs from last November? Are we going to see breadth widen out here? How meaningful is that to this market?
This is still a large cap market. And, I've heard so many people say, well, it's all the growth stocks. It's actually the large cap stocks, because if you look at Russell 1000 growth and what Russell 1000 value, they have almost identical performance this year. And small cap growth has done quite poorly this year. So it's the cap factor that really has been at play in what's been working, more so than the growth versus value factor. And when you have that cap factor working, given the dominance in terms of contribution to returns in the cap-weighted indexes, it makes it difficult for equal weight to play catch up to those cap-weighted indexes.